this is a rather rush video because of the recent spike in REITs prices the last 2 days, right? Yesterday and today, right? I actually originally wanted to cover 3 REITs, but I don't have time to finish the slides for the last REIT, right? So I'm just going to cover 2 first, right? In fact, I'm maybe slightly late already, right? Please note, I'm not a financial advisor, and this is not financial advice. I may make mistakes and do not guarantee information shared is all accurate, right? So basically, none of what I'm saying is financial advice, okay? Right, moving on. Why do I like FCT? All right, generally speaking, FCT, I like it because of the organic growth in the regions in the north, northeast, and east regions. Right, so there's new supply of homes that have just finished building. Some of which is because of the postponement of the release of the flats due to the COVID delay in the building of the flats. Right, so this delay has caused the flats to just be released recently, and people are moving into these areas, right? So this will give FCT organic growth around their malls catchment area. Right, this should naturally drive high shopper traffic and tenant sales growth, and I do believe it has already been reflected in the first quarter 25 numbers, right? So this was a non-DPU report, right? In the latest quarter, you can watch my latest video FCT, right? Shopper traffic is up 2.7%, but more importantly, is tenant sales is up 2.5%, right? You may say, hey, this is not that impressive, but 2.5% is only roughly inflation. But if you look at the numbers from the previous quarters, actually this is quite a decent number. And if you compare with CICT, which is, if you strip out Ion Orchard, right, is something like 0% sales growth, right, or minus 0.1% sales growth, or on the latest recent quarter that is matching this quarter for FCT, right? I think this is a pretty decent and maybe even a good result, right? Right, median household spending from work should grow over the long term. All right, this one is something that I think is true because of something I heard from Fisher Investments, right? There's a good YouTube called Fisher Investments if you really want to listen to it, right? They said that generally inflation, right, in terms of cost of living, comes before the wage growth that follows, right? So that means to say things cost more first and our wages stay stagnant, right? But in a few years time, our wages will catch up, right? So I think we've already gone through a period where there's high inflation, whereby our food cost has gone up and our daily necessities have gone up in prices. Over the next few years, we should likely see a growth in income across the board to match the inflation that has already passed, and this should increase household spending. Finally, we know that CDC vouchers are coming again, right? And other things like progressive wage model should help improve everyone's spending capacity in these regions, right? Another good thing about FCT is cost of debt is going up. Cost of debt is going down, right? You can see 4.3% to 4.1% for 3 quarters. Finally, the last quarter is 4%, right? Hopefully this will go below 3%. Go below 4% soon, right? So couple of good things. Looks like sales is going up. Likelihood the rents will go up as well, right? And cost of debt is going down, right? So it looks like the revenue, the top line is going up, and the cost of debt is going down, right? So all these things are positive, right? The only risk the only reason why I could think of why the price of SCT is suppressed is because of the Singapore Johor Bahru RTS link, right? This one I do not believe is as big of a problem as people think it is, right? FCT itself thinks is a good thing, right? I'm more in the middle, in the sense that I feel like there will be very little impact. Why? Because if you think about it from a Johor businessman perspective, right? When the RTS link is very well, it is built up and is actually very efficient, basically this part of Johor will actually seem like Singapore, right? Because they realize, the Singaporeans are coming over with spending power. They used to buy something for $1. Maybe Johor is selling it at 60 cents, right? They realize that there's opportunity to up the cost of what they're selling to 80 cents or maybe even 90 cents. And they can simply justify it by the fact that in this region, right, once this RTS line is built properly, the rents will go up, right? So they can say my cost of business is going up, right? Anyway, my current spenders have the money to spend, right? So why not I up the price of my goods, right? So the difference between spending in Johor and Singapore, I believe the gap will close, right? Once this RTS link is built up, and that will reduce the impact of whatever impact this has over the malls in this region that supposedly might get impacted by this RTS link, right? So anyway, moving forward, we know that there's limited retail space in Singapore, right? Clearly, so whatever FCT has in the heartland regions are more or less the dominant malls in the region. I don't think they will have significant competition coming up, right? So we look at uh, when I was actually looking at it, which was over the weekend, I think the price was $2.07, right? Something like that. The yield was 5.8%, which I thought was quite attractive given that I I foresee that this should improve. All right. So I was anticipating a forward yield of about 6%. This is off last annual reports yield, right? But currently today, as of speaking, the price just shot up to $2.20, which is which makes the yield a lot lower at $5.47. So you have to decide for yourself if this is worth entering now, lah. Okay. Uh, Balance sheet wise is slightly worse in terms of leverage, just slightly higher, right? Interest coverage ratio is 3.3 times as well, slightly lower, right? So these are both not good things, but not a big deal lah, given the most relatively stable operations, right? Only something like COVID may uh, significantly threaten the existence of FCT. Okay, so uh, average all-in cost of debt, like we talked about, is dropping. Debt maturity, are not super concerned about this, right? Percentage hedge to fixed rate is dropped to 65.5%. I think this is a positive thing because of dropping interest rate, right? So they'll benefit more than, for example, CICT or Ascendas, which both has fixed rates at above 80%. I think both is around 83% fixed rates. Okay, so FCT should benefit more from the dropping interest rates than the other two. Right, so that's why I like FCT. This is last year's financial results. So this is from fourth quarter 24. The latest quarter is first quarter 25. Right, so you can see the sales results are it's quite bad. It's like only increased by 0.7 and 0.6%. Right, so the last few results for sales quite bad. That's why I said 2.5% sales increase. Right, it's not too bad. Right, maybe it shows that the retail side is recovering, right? So the next week I want to look at is Ascendas, right? Ascendas, I'll just look at stats, right? So this is just a shout out for retirements blog because I use all the slides here from his blog, right? So how to go about getting the slides I'm about to use? Go to retirements blog, right? You click on REITs info and S-REITs dashboard, then you select the REIT you're interested in below, right? I'm looking at CLAR, right? So this is the breakdown of where the properties are, okay? So why do I like Ascendas, right? Generally, if you look at their dividend yield is trading at roughly between 1 and 2 standard deviations, right? Positively, that means to say this is considered cheap lah, right? So it's trading between the average dividend for Ascendas is apparently 5.33%, right? So currently it's trading between +1 ST and +2 ST, right? This one may be slightly off dated because I took these slides I think 1 or 2 days ago. So if you want the latest slides for this, you can again go back to retirement blog, right? So I believe that this Google rather this data is updated live as of what I understand, right? So country weightage wise, I like because Ascendas slightly over MIT because I'm currently a bit worried about US. If you look at across the board, US the occupancy is quite low, whether it's Ascendas or MIT. And MIT has a higher proportion in the US, right? Ascendas tend to be more localized in Singapore. US is only 13.3%, right? So this is the part that I'm a bit worried about. Plus Trump doing all the funny things lah. Of course, the tariffs here and there. We don't know what will happen, and this makes the US part of the portfolio for any REIT lah, I think quite risky at this point, right? Not financial advice again, right? So what other good things about the retirements block? You can see here that the gearing ratio is 37.7%, and he includes the calculation of hybrids here, right? So very good that you know actually their real gearing ratio is 39.4%. So you can sleep soundly to know that even though Ascendas has hidden debt like perpetual securities, right? It's actually still below 40%, even if I include this, right? So it's a very safe REIT, right? Cost of debt is pretty low at 3.7%, right? Even lower than FCT. Right, you can see the fixed rate debt is 82.7%. As I said, Ascendas and CICT tend to be very conservative, so they'll benefit a bit less from the drop in interest rates. Alright, price over NAV, obviously lower is better. Again, it's trading, I think, slightly below 1 standard deviation, which means it's cheap. Alright, or at this point, it could be around -1 exactly standard deviation. Right, and a deep yield trend, I think this is the most important thing, right? As I predicted, the trend here is upsloping, right? So the last 3 quarters have been good results for Ascendas. Right, with that, I'll end the presentation. Please remember that none of this is financial advice. All right, please do your own due diligence if you are considering either of these two REITs. All right, if you feel like I've given you some value by discussing all these things, please do give me a like. Right, and thank you for listening.